happy to welcome back to Forward Guidance Darius Dale, founder of 42 Macro. Darius, great to have you here again.
Hey, Jack, it's a pleasure to be here, man. You put out one of my favorite podcasts out there. You're one of the hardest working people in our industry, man. I just want to say we appreciate you.
Thanks, Darius. You are the hardest working man in the industry. I appreciate you. Darius, what is going on in macroeconomics? It seemed, let's say, wind the clock 2 months ago, 3 months ago, soft landing was something that, if someone was on TV, they'd say it to be nice. The CEO of Goldman Sachs would say soft landing, but many, macro analysts who, like to peer behind the veil, soft landing was, maybe 10%, 5% probability. But the economic data, is my understanding, just looking at the prices that has come out recently, has been very soft landing-ish. Explain what has gone on over the past few months.
Ooh, that's a loaded question. So I'll give you our take on it. So as you know, at 42 Macro, we run our systematic process, what we call our grid model. That's a quantitative process that tries to forecast where the economy is from a regime segmentation perspective. And it was always going to be the case that once you got into December and really through the springtime of this year, March or April, that the probability of achieving Goldilocks, and not just the U.S. economy, but the global economy, was actually quite elevated, in the range of 25 to 35%, pick your economy. That's up from, basically 0% in the preceding, kind of 6 to 12 months. So we are now in an area where the markets are apt to look around for Goldilocks type signaling. And that's exactly what we're getting, both from an economic and policy standpoint. I'll start on the policy side. Nothing bigger, in my opinion, than the inflection in the Chinese policy, both with respect to zero COVID, basically ripping off that Band-Aid. But in my important that the reopening is not necessarily the biggest catalyst coming out of China. To me, the biggest catalyst coming out of China is the fact that it appears very likely that the PBOC, the fiscal authorities in China, are actually readying a meaningful stimulus package to be thrust into the Chinese economy as soon as Q1. We got a lot of guidance out of the PBOC. I want to say Guo Shunqing over the weekend that effectively said, hey, look, we're going to be targeting consumption. We're going to be targeting investment. We're going to make it easy for small businesses and private companies to get access to capital markets. We're going to take our heavy hand off the big tech industry. So they're effectively doing what they need to do to generate capital flows into the Chinese economy and ultimately allow them their reopening process to grow on more sustainable footing. So that's number one. This is the world's second largest economy. It's going to be a big deal, at least in the first part of the year. Number two, with respect to the data, obviously we got CPI data earlier today that were confirming of the ongoing disinflationary trend in the U.S. economy. If I can throw one statistic at you, because there's obviously a lot of statistics within the CPI report, but in my opinion, in terms of the CPI, we get two sort of separate sets of statistics each time we get the CPI. In the morning, I would argue the first most important statistic in the morning at 8:30 is a core services ex rent of shelter, and that number decelerated from 3.2% to 1.2% on a 3-month annualized basis, and that's the slowest print we've seen since June 20. We also saw some pretty significant movement to the downside in measures of underlying inflation, albeit to levels that are very inconsistent still with the Fed's mandate. These are the numbers that you get throughout the day from the Cleveland Fed, Atlanta Fed, et cetera. Median CPI, just anchoring on that, for instance, decelerated 110 basis points to 5.5% on a 3-month annualized basis. Obviously, well north of anything that's comfortable for the Fed's perspective. But these are numbers that are coming down from levels that look like, 9, 10% in recent months. And so it's obviously given the market 2 thumbs up to believe in this sort of, when my friend Bob Elliott over at Limited Funds, him and I had a discussion yesterday. He termed it the transitory Goldilocks, which ultimately we believe this is exactly what markets have moved to start pricing in really since kind of late December.
So transitory Goldilocks phase where economic growth goes up, but inflation goes down. So that's really good for the economy, really good for risk assets. Yeah, would you say this has been a surprise? Because I think a lot of analysts, I think maybe it was even mainstream, had anticipated that growth would decline a lot, especially after you had those 2 consecutive quarter over quarter real GDP prints that were negative. Has this been a little bit of a surprise?
Again, not from our perspective. So, you've probably heard me on different podcasts, different shows, et cetera. Certainly, you obviously get our research, but, it's been we've always found at the table that the fact that the U.S. economy in particular has a lot of resiliency to it. Look no further than the labor market to understand that level of resiliency. I'll throw a couple statistics at you just coming out of today. We had jobless claims decline to 205,000 initial claims. That's a secular low. continuing claims. It's been inflected. It's inflected to the downside actually in mid-December, and now we're tracking at 1.6 million, down from like 1.75 million a couple of weeks ago. So we're now actually seeing incremental strength in the labor market vis-a-vis the lens of jobless claims. A variety of other metrics continue to show strength, whether you look at real consumption, real PCE growth tracking at 3% on a 3-month annualized basis. You think about nominal employee compensation, which is, in my opinion, the number one thing the Fed is focused on, because the labor market, the tightness of the labor market, in my opinion, is they're kind of driving their mandate at this particular juncture. That number is at 6.1% 3-month annualized. And obviously 3-month annualized, CPI is somewhere in, got a one handle on it. So there's a lot of real income growth that is being generated, particularly in the U.S. economy now. And then you look abroad, obviously China ripping off the Band-Aid with zero COVID, adding stimulus to that mix is going to create a positive growth impulse there. Jury's still out in terms of how big the growth impulse there. We've seen China bail out the global economy in 2008, 2009. We see it do it again in 2012, 2013. We saw it 2016, 2017, saw it in 2020 as well. Will it be a program as big as those? Or will it be, something more moderate, more tepid? I don't think we know the answer to that, but we do know the delta is positive. And then lastly, that's obviously going to be quite positive for Europe, which itself was already improving from a sequential standpoint, from a growth data standpoint. Going back to November, December, we already saw the leading indicators in Europe really bottom out at the height of their energy crisis. And a lot of things have really inflected to the positive side. So right now we are in this transitory period where the markets were forced from lower levels in risk assets, higher levels in interest rates, to acknowledge the fact that things got a lot better relative to where they were, let's say in November, using that as an anchor in terms of economic data. But it's not, in our opinion, it's not going to last.
Okay, so it's transitory, not going to last. Yeah, I mean, if we're in Goldilocks, and so we say we're in Goldilocks now, I think what's important is is it going to be Goldilocks in the future, and for how long? Because if it's Goldilocks and it's going to get more Goldilocks for the next year, easy, simple asset allocation, right? If you're a subscriber of 42 Macro, buy stocks, and the riskier the stocks, the better. The riskier, the higher beta, the better. Let's buy Bitcoin. Let's buy Ethereum, Solana. Why not? All the risky stuff go long in Goldilocks. So is that your asset allocation? And if not, why not?
Yeah, great question. So we'll start by saying, just in terms of thinking about market risk, in Goldilocks or in any other of the four group regimes that we track, Goldilocks, what you typically see is that reward, it tends to be positively correlated to risk and has a positive upward slope, meaning the more risk you take from a volatility and covariance perspective, vis-a-vis our back test, we back tested everything that ticks vis-a-vis that regime segmentation process. The more risk you take, the more return you tend to get in these types of environments. Now, again, we are not in Goldilocks from an economic standpoint. Growth is still trending lower. Inflation is still trending lower. We are technically in what we call deflation. It's just a more milder form of deflation than we had experienced in recent months, particularly in the global economy. And ultimately, that third derivative inflection, that positive third derivative, is actually catalyzing some more Goldilocks type asset market performance, right, given the starting point of very negative, very defensive positioning amongst investors.
Okay, thanks, Darius. I just want to hone in that. So technically, we are actually in the real economic world, in a world of deflation where growth and inflation are falling at the same time. Yes. Which historically is very bad for assets. It might be okay for assets now just because inflation has been so high. But you're saying in the world of asset prices, in the matrix, that's trading as if it's Goldilocks.
Yes, absolutely.
Okay, yeah.
Absolutely. And the reason for that, again, I think it's twofold. One, the starting point, we were, you go back to late December or even, late September, early October, which is really, in my opinion, where a lot of this stuff inflected from an international standpoint. Positioning was extremely bearish. In fact, if you look at positioning now across, most assets that would be, risk assets or anything in the long duration space, investors are still leaning very short of risk parity type strategies. And so I think what you're seeing now is the combination of, better than expected news on the economic front in terms of faster decelerations in inflation than expected, and not necessarily today, but obviously the last couple of prints, and then better economic activity than expected. And oh, by the way, the world's second largest economy is waking up and stimulating. That is new news that investors were not positioned for and ultimately been forced to price in, if only because of short cover.
That makes sense. Yeah. So how are you thinking about asset allocation if we're in deflation, but assets are trading as if we're in Goldilocks?
Yeah. So before we even get to asset allocation and our thought processes, portfolio construction, which I believe we specialize in at 42 Macro, I think we also have to consider the full distribution of probable economic outcomes, because it's not just this transitory Goldilocks that we have to contend with. As you know, you've seen our research. We always help investors, understand that full distribution of outcomes vis-a-vis our modal outcome scenario, our right tail risk scenario, and our left tail risk scenario, and we're constantly using data to help investors understand, hey, what's the probability of those tails? And are we ceding share to the tails from the modal outcome, or are we ceding share from one tail to the other tail? And ultimately, that's how we think about constructing portfolios to take advantage of those changes in probabilities. With respect to the modal outcome, it's our bias and it's been our bias for an extended period of time now, which is the U.S. economy is unlikely to go into recession at least until the second half of this year, probably not until Q4 of 2023. And so that process of, gradually decelerating and building up momentum to the downside is going to take a while. And as long as that process takes a while, you're going to continue to have a tight labor market that is creating inflationary pressure vis-a-vis wages. And so that's something that, in our opinion, is likely to cause the Fed to tighten more relative to expectations, both in the first half of the year with actual rate hikes, but it's also going to tighten relative to expectation in the second half of the year relative to not cutting rates relative to what the market is currently priced in. Don't forget, markets are already, and if you look at Fed funds futures, markets are effectively calling for the Fed to get to 5% in March and holding there through November, and then enacting 50 basis points of rate cuts in back-to-back meetings to close out the year. I think we could easily go to 550, if not 6%, on the Fed funds rate in this process, because history shows you tend not to see significant decelerations, significant breakdowns in wage growth, in the tightness of the labor market absent a recession. So as long as we're not in a recession, you should expect the Fed to continue to anchor on labor, which it signaled that it will continue to anchor on labor and ultimately deliver more tight policy than we expect. And in respect to the second half of the year, obviously, if the recession starts later, that means the Fed's not going to have any data from a labor market standpoint to cause it to pivot and actually start supplying the market with liquidity. So we think 2023 is going to be a year in which the Fed is likely to disappoint investors, both to the upside in rate hikes and also to the downside and rate cuts relative to what's currently priced in. So that's our modal outcome perspective. That is, in our opinion, the number one driver of asset markets on a medium-term duration, kind of 1 to 3 quarters forward. So that's kind of in the center of the distribution. What's on the right tail of the distribution, which I think the markets are very clearly responding to now, is this transitory Goldilocks, phase. I don't believe that transitory Goldilocks phase has legs, into the second half of the year, because there's a variety of catalysts that I think are very much likely to cause asset markets to sort of, kind of pivot from focusing on that. Let's start with going back to the U.S. economy. What we're going to get, obviously 4 Fed meetings between now and June. But my opinion, I think we have to be very comfortable, or very, as investors, very keen to be focused on the March and the June FOMC. March is on the 22nd and June is on the 14th. And the reason I say that is because as long as we're in this transitory Goldilocks type environment, the risk to asset markets is a Fed that just says, I don't care, right? I don't care. Screw your Goldilocks. I'm concerned about the labor market. And oh, by the way, just a quick tangent, the Fed pivoted in December. It hasn't been priced in, or it got priced in a little bit in December, but since then, obviously, it's become less of an issue because the markets are obviously focused on other dynamics, namely China and disinflation. But the Fed pivoted in December in two ways that I think are really important for every investor to understand. One, they upgraded their evidentiary standard from clear and convincing evidence to substantially more evidence. In my opinion, I think these are actual legal terms. Don't forget, Powell's a lawyer from Carlisle. And so in my opinion, I think that is a direct signal that, hey, look, we don't just need measures of inflation. Let's go back to our median CPI friend, right? It's at 5.5% 3-month annualized. Trim mean CPI came in at 4.7% 3-month annualized in the month of December. These numbers are going to be below the Fed funds rate in 1 to 2 meetings. I think the clear and convincing evidentiary standard would have said, okay, that's enough. The Fed can get to the sidelines, dock the boat and just watch the disinflation process continue from there. Substantially more evidence, in my opinion, suggests that the Fed is probably looking for measures of compounded inflation, 3-month annualized, month-over-month annualized, really 3-month annualized and longer durations than that, to tell them that we are actually going back to and potentially through 2%. Because don't forget, we can't just stop at 2%, because if we stop at 2%, we're going to reaccelerate in the subsequent inflation cycle, and 2 is not going to be the mean. 2 is going to be the lower boundary. So the Fed has to, consistently think about inflation and subsequent business cycles as well. So number two, with respect to the Fed's mandate, which I would argue maybe even more important than number one, which is the Fed upgraded the labor market and its reaction function and downgraded inflation. So it's effectively the Fed pivoted from the thing that is causing the markets to be most excited about a Fed pivot to a thing that should cause markets to be least excited about a Fed pivot, because it's the thing that history shows is least likely to break down ahead of a recession, which ultimately means they're going to be at it for longer. So I do believe that's going to cause investors to be the Fed is going to force the market narrative back to where it is, which is we're not done. We're not going to be done for a while. And when you think we're done, we're not going to cut. We're not going to give you QE until all hell breaks loose. And I think markets are going to be forced at the very latest this year by the summary of economic projections, the dot plot, and the core PCE and unemployment rate forecast in the June FOMC for the Fed, for everyone to realize that. It may happen in the March FOMC, but I don't want to make a big bet on that. I certainly believe by the June FOMC it'll happen.
Right. Okay. So the Federal Reserve is now more focused on the labor market and less focused on actual inflation. Like, I know Powell has been talking about the labor market a lot and wages, but is there any particular comment he made or something that the Fed did, some sort of data release that you call the Fed say they really have switched their focus?
Yeah, no, I mean, just go back to the December FOMC, the September 14th. I mean, it was very clear and consistent that, hey, look, we understand that inflation's coming down. I mean, I'm paraphrasing, obviously. Yeah, we understand that inflation's coming down, but look, the labor market is very inconsistent with our inflation mandate. And so and not only did Powell echo that in the press conference, we've heard subsequent members of the FOMC come out and reiterate that. And we also heard it from the Fed minutes. And one final thing in that Fed pivot scenario in December that I think is underreported across financial media, which is the cohesion of the dot plot, in my opinion, supports our view that when the going actually gets tough economically, which we believe by the second half of this year, we'll be on that real path towards recession. Right now, we're kind of in this muddle down through period before the gradient really starts to accelerate to the downside. Our grid model has the probability of deflation rising starting in the middle of this year and, going to 80-90%, which means we're just going deeper and deeper into the regime. And so that's when I believe that recessionary process really starts to take hold, ultimately landing us in recession by Q4 of this year, at the latest Q1 of next year. But going back to that cohesion in the dot plot, that lack of dispersion, to me, it signals that there's not going to be a lot of debate amongst committee members and amongst committee members throughout the year when the going actually gets tough, when the unemployment rate actually starts to rise. When PMIs and services PMIs are actually consistently, in the 40s, and GDP is, tracking at 0 to, slightly negative. When those data points are really starting to come out, the Fed is not going to sit there and go, oh my God, I got to start cutting interest rates and I got to start doing QE. They're going to say, I told you so. Yeah. I'll give you two statistics, Jack. Two of my favorite statistics. I'll start with the December summary of economic projections, where the Fed introduced its latest forecast for core PCE and the unemployment rate. And so at the December the December FOMC, within that SEP, the summary of economic projections, the Fed called for core PCE to decelerate to 3.5% by the end of this year, December 2023. From that time, it was at 4.7%. We've never, in the history of the core PCE time series dating back to 1950, late 1950s, seen a 120 basis point deceleration in core PCE without a recession. And so implicitly, the Fed knows that, hey, we probably need a recession to achieve our inflation mandate. But to me, I think that's less relevant in terms of their likely reluctance to pivot in the second half of this year when the going actually gets tough economically, domestically. The unemployment rate forecast call for the U3 rate, the headline unemployment rate, to spike to 4.6% from 3.5% in December. That's a 110 basis point rise. And we've never seen a 110 basis point rise in the unemployment rate over a 12-month time frame without a recession. So in my opinion, I think this very cohesive unit of the FOMC are implicitly forecasting a recession, which means when we start seeing recessionary-like conditions, the markets are not going to get what they want out of the Fed when that happens. And that's going to create some real significant problems in the middle of the year, to say the least, starting in the middle of the year, in my opinion.
Darius, I didn't know those two data points specifically. That's very interesting, and to me, it kind of is further evidence of a view that you and I share, and a view that's been kind of on full display for almost a year now, which is the Fed says that we'll hike to X, and the market doesn't believe them, and the markets rally, and then they realize the Fed does hike to X, and then markets realize, oh shoot, we were wrong. And then the Fed says we'll hike to 2x, and the market doesn't believe them. The market rallies, and then the Fed does hike to 2x. Yeah, so you have close to 200 basis points of cuts from the, it's like, I think Fed funds futures is 5% or just shy of 5% in May or June or July of 2023. And then the end of 2024, it's close to 3%. So what is the market doing where it thinks the Fed's going to cut by 200 basis points? Obviously, if a recession happens and it's very deep and severe and long lasting, that would happen. But in what scenario other than a deep recession would the Fed cut 200 basis points?
Yeah, no, it has to be a deep recession that is deeper than their expectations. Because again, I believe this is a Federal Reserve Board committee that is implicitly forecasting a recession to begin in 2023 via the projected deltas in core PCE and the unemployment rate. And so in our opinion, I think the market is going to continue to get a lot of pushback from the Fed and ultimately get the reconciliation process that we've consistently seen over the past 9 to 12 months. The Fed always wins. This is why there's an argument, a saying out there that says, don't fight the Fed. I think you can, at the best as an investor, try to front run the Fed by using the analyzing and forecasting the data that they have their eyes glued to, not data that, you think is cool or is a cool chart. That's what I think we specialize in 42 Macro is, figuring out what these people care about and then forecasting that accurately on a consistent basis. And so in our opinion, I think the market's going to continue to get a lot of pushback from the Fed, which is why I highlighted the March FOMC and the June FOMC as potential catalysts for a reversal in this transitory Goldilocks narrative. Because again, in the absence of the updated summary of economic projections for the market to confirm that, hey, look, they mean business with their unemployment rate, their growth forecasts, et cetera, there's a Fed that's not going to pivot, then, the market can do what it wants in terms of, anchoring on China reopening and stimulus, anchoring on the Goldilocks data that we're getting out of the U.S. and global economy at the current juncture. But one thing I will say is, we haven't talked about our left tail risk scenario, which I think is somewhat credible. It's less credible now than I think it was prior to seeing the Chinese stimulus headlines over this weekend, which is, if we're wrong and the U.S. economy has less resilience than we believe it does in terms of the balance sheet health of the consumer and corporate sector, which we can talk about. If we're wrong on that and a recession materializes sooner, it hasn't been priced in. Like it not even close to being priced in. We look at 4 different metrics to track recessions vis-a-vis previous business cycles and see, the current levels and the current deltas relative to, levels that they've achieved in prior business cycles and deltas and the speed with which they got there. And, if you look at financial conditions, anchoring on the Goldman's Financial Conditions Index, if you look at investment grade credit spreads, high yield credit spreads, and then the relative valuation between high beta stocks, which have more leverage and are more levered to the economic cycle than their low beta counterparts, at a 50% valuation premium, we're like 50% higher than levels that correspond to a non-recessionary cyclical slowdown, let alone an actual recession. And you look at things like credit spreads, et cetera. I want to say investment grade credit spreads at 160-ish basis points. On a mean basis, if you look at the last 3 recessions, we got to 453 basis points over. That includes the shallowest recession in U.S. economic history in 2001, one of the deepest in the GFC, and ultimately, and obviously the 1990 to 1991 recession, I believe, is the 3rd shallowest in history. So you got a lot of different recessions in there in terms of the deltas, but from where we are today in terms of having priced that in. High yield credit spreads, Jack, 428 basis points wide at the current juncture, a little bit less than 400 now. If you can get to 1,500 wide on a mean basis in terms of the last 3 business cycles. So again, it's very clear to me that if we're wrong on the resiliency of the economy and the recession starts sooner than, say, Q4 of 2023, maybe even 1 or 2 quarters sooner, then the market's going to have a problem. But again, I think that's a declining probability from a risk management standpoint in terms of our 3 scenarios.
So your modal outcome and your left tail risk are different in terms of timing. modal outcome is recession won't happen until Q3 or Q4 of 2023. Left tail is that it starts much sooner. But is the outcome different? But in terms of like, could a recession happen in Q3 or Q4, but it's as severe as it just starts 3 months later?
Yeah, so it is a little bit different from a risk management standpoint, right? Like you need to understand that, not you, but we need to understand as investors that, hey, look, it might be safe to go in the water and buy a bond today in the left tail risk scenario, because again, ultimately it means that, hey, look, the Fed is at the bare minimum, let's say, 1 to 2 quarters sooner to effectively pivoting, when they will, finally pivot, which I believe is a 2024 event in terms of supplying the market with liquidity. That's a big difference if you have to wait 6 months on that. If the modal outcome scenario remains the modal outcome throughout the year, in terms of resiliency of the economy, Fed pushing back against market expectations for easing, Fed pushing back against, easing of financial conditions broadly throughout that process, then it's very unlikely that you can buy a bond at this particular juncture, in my opinion, because again, you still have the whole entire, kind of major developed central banks, ex-China, tightening monetary policy, including Japan. They're actually going to do a review of the side effects of their, quantitative and qualitative easing program at their meeting next week. In our opinion, I think that's a leading indicator that there are going to be continued, revisions to the yield curve control policy that ultimately result in a tighter monetary policy out of Japan. So you got BOJ there, and obviously Kuroda's out of here in April, and so his replacement, he might be setting his replacement up to actually do a little bit more on that front. I'm not making that call. I don't know if I know enough to make that call yet, but certainly in moving in the tightening direction. Obviously, Fed still in the tightening direction. As long as China is, adding in a growth impulse to the global economy, which again, we expect it will, certainly in the first half of this year, Europe's going to be in a better footing from an economic standpoint. So ultimately, that means the ECB can tighten more, and what's probably currently priced in, and the Bank of England is likely to be able to tighten a little bit more than what's currently priced in. So we're still in this liquidity cycle downturn globally, ex-China from a fixed income standpoint. And so I think it really makes the bond buying call here today a very difficult call, and one we don't agree with. So I think that's the big difference.
And that's a timing thing. You think in 3 months it might be time to buy bonds, but not now.
The only thing that matters in markets, man, it's time.
Yeah. Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Darius, I want to ask you about growth because, you follow very complicated economic data, and then you make it even more complicated by the way you sort of analyze and process it. I'm a simple guy. Okay. That's why I like PMIs. Manufacturing PMI above 50, economy is growing. Below 50, it's contracting. The manufacturing PMI, I think, correct me if I'm wrong, I think it's below 50, and the services PMI is below 50 as well. Maybe that's just one or two recent, and you know the data infinitely more than I do, and they've come down from being in their 60s, a pretty straight line to 50. Now it's 49. Next is 48, 47. It sounds like the economy is slowing pretty quickly. And I get the labor market is, robust, and unemployment rate is 3.5%. But recessions can start when the unemployment rate's at 3.5%, right? What in terms of the underlying I get the labor market, setting labor market aside, which is very strong, of course. What gives you sort of hope in the resilience of the American economy that we, wouldn't start to go into recession like right now? Because, recession, MBER dated it to December 2007, I think, right? And no one was thinking, unless you're a macroeconomist, was thinking, a recession start before things start to get bad, as you know.
So great questions, Zach. I think PMIs are a useful tool because they do, they're a very timely leading indicator that a lot of people care about. And so at the bare minimum, it helps you aggregate what other investors think about the deltas on growth. And so they're very important, but I don't know that they're particularly instructive in telling you what the actual level of growth is. I've done obviously a tremendous amount of econometric analysis in terms of trying to relate PMIs back to other indicators in the economy, and they tend to be they tend to be fairly co-integrated. But in terms of using it as a tell-all metric on the economy, I think it's somewhat dangerous, particularly in the context of the manufacturing PMI. Don't forget, if you look at the U.S. economy, 82% of our GDPs comes from the services sector. 86% of employment comes from the services sector. So when you talk about a manufacturing sector in the U.S. economy, you're talking about your pinky relative to the rest of your body. You know what I mean? Yeah. So I just want to make sure investors are aware of those types of statistics. But the one thing I would say on just in terms of kind of some of the hard data that we're looking at, to confirm the fact that we're not in a recession, just look at the services consumption. This is data through November. Real services PCE, personal consumption expenditures, which a PCE in aggregate is 70% of the U.S. economy. It's compounding at 3.3% on a 3-month annualized basis. That number is like more than 50% higher than its pre-COVID trend. And why do I believe in this resiliency story? And why ultimately the resiliency story just means it's going to take us longer to get to recession than the consensus believes at the current juncture. Because again, Wall Street consensus is recession first half, markets bottom first half, they rally in the second half because the Fed pivot. Our view is somewhat not necessarily quite the perfect opposite, but it's quite different. We think markets chop around and using S&P as an example between, let's say, 3,800 and 4,100 in the first half of the year, which I think you can trade with a bullish bias because of all the transitory Goldilocks type dynamics. But ultimately, that's going to give way to a really crappy second half because, again, you're going to run out of that Chinese growth impulse. U.S. growth is going to start to accelerate to the downside alongside all the other major economies in the world, ultimately leading into a recession process in the U.S., Europe, and a large parts of the developed world, certainly by Q4, or not certainly by Q4, but likely by Q4, certainly by the first half of 2024. So, we have problems in the second half of the year. And ultimately, I think that back half rally story that Wall Street is really anchoring on, I would take that and sell that as far as the eye can see. But in terms of the resiliency now, the household sector balance sheet is it's as good a shape as it's ever been. I mean, I make no bones about that. Consumers, if you look at their checkable deposits, they have $7.9 trillion of cash on their balance sheet right now. When you add up checkable deposits and money market fund shares, that number is 5% of total assets, which is the highest number we've seen in the history of the time series. Consumers have never had this much cash, both in terms of the nominal dollars, but also in terms of the share of their overall balance sheet.
What about 2021 though?
2021. What do you mean?
It's above 2021.
It's the chart looks like this.
Okay.
You can be long with chart. Yeah, I'll send it to you so you can show the viewers. But no, it's extremely bullish from that perspective. Now, obviously, there's some sectoral and compositional issues in terms of maybe the lower end consumers from an income distribution perspective have less checkable cash than their upper income counterparts. But don't forget that upper income counterparts tend to do all the spending in this economy. If you look at the top two deciles of consumers by income cohort, they actually account for 40 to 45% of total spending. So, the rich folks in this country really outkick their coverage from a spending standpoint. But that's just these kind of the asset side of the balance sheet. If you look at the liability side of the consumer balance sheet, household debt is 101 cents on the dollar. If you look at the ratio between total debt and nominal disposable personal income. So that number is, well down from, where it was in previous cycles. I think we peaked at 134 cents on the dollar heading into the GFC. So consumers have not levered up. They have the ample capacity to lever up, and they certainly have the cash to service that debt, but they don't really need to because, again, debt service ratios, which I think is as important as an indicator as anything when you're talking about financial tightening and ultimately the business cycle. The household debt service ratio is practically an all-time low at 9.8% at the current juncture. So, this U.S. consumer, this U.S. consumer-led economy, 70% of GDP, has ample capacity to keep muddling through, particularly if inflation continues to surprise to the downside because it flatters real incomes in the process. Now, ultimately, that's not a sustainable dynamic because, again, the Fed, in our opinion, is going to take the policy rate into a restrictive setting. It's not restrictive now, but it will get restrictive. And ultimately, that restrictive process will start to, kind of feed upon itself and ultimately caused some negative outcomes in the labor market that kind of put all that to bed, in our opinion, likely by Q4.
Okay, right. So tell me about the household debt service cost. That's very low, even with the Fed increases.
Yeah, absolutely. Yeah, that's data through the third quarter. So one thing I'd also call out, obviously housing has fallen off a cliff from a sales and activity standpoint, and that
Right.
makes a lot of sense. Mortgage rates have skyrocketed to north of 6, maybe even 7%. Last time I checked. But if you look at it on an effective basis, the nationwide effective mortgage rate is 3.42%. And so the reason new home sales, pending home sales are down 35 to 40% year over year is because you, me, and no one we know is stupid enough to trade their 3.42% mortgage for a 7% mortgage. So no one's moving. Because no one's moving, we continue to see activity collapse in the housing market. But from a leverage cycle standpoint, it's just not that onerous. The household debt service ratio, if you look at mortgage debt specifically, is at 4%, which is practically an all-time low. And then household debt, mortgage debt, at 66 cents on the dollar is well shy of prior business cycles. Namely, heading into the GFC, we're at 99 cents on the dollar. So this is, in my opinion, I think, the bloodbath that we're seeing in housing that obviously is causing, the goods disinflation, the contraction in the goods economy, vis-a-vis the manufacturing PMI, et cetera, leading indicators obviously falling off a cliff. I think that stuff is more contained than the average investor realizes, which ultimately means the economy is more resilient than the average investor realizes. And that sounds bullish if the Fed weren't tightening. If we weren't in a liquidity cycle downturn, it'd be fine. It'd be great. You'd be buying everything. The issue is the reason I think the market has upside, kind of resistance in this kind of push-pull between transitory Goldilocks and our modal outcome scenario is because the economy is resilient. And you historically just have never seen a significant, kind of breakdown in wage pressure absent or outside of a recession. So the Fed's going to need to get that if it wants to actually achieve its inflation mandate.
Mm. And so the I remember the banks, which are going to report tomorrow, actually on the 13th. Bank of America, for their third quarter, they had this chart of just people's income. Like, if in 2019 you had $2,000 in your bank account, now you have $6,000. This is actual bank deposits, like actual money. So yeah, the strength of the consumer balance sheet very strong. Wages are going up by a lot. You had fiscal stimulus that is a hangover of that. But it's not headed in the right direction. We're headed towards this, right? Because credit card spending is going up. Things are getting more expensive. Prices over the past year have gone up more than wages. That may not be true over the next year. Who knows? But that is eating at people's purchasing power. So, do you see that being a disinflationary force or a recessionary force of just things cost way more money, so people don't have as much money, and they're having to use their credit card instead of using their actual money?
Well, I don't think we need to make it that complicated. The recessionary force is going to come from people losing their jobs, right? Once we go into a significant decline from a corporate profitability standpoint, you're now going to put the spotlight on C-suites to make hard decisions. It's been very difficult to find and retain talent in this business cycle. I own a business. It's very difficult to find and retain talent. This is why we're seeing wage growth at levels that we have not seen since the early 80s, early to mid 80s. So that's part of the reason. Part of the reason for that, obviously, we've seen a pretty significant secular decline relative to trend in the total amount of the labor force, in the total size of the labor force. The Fed's forecast or the Fed's estimates suggest that we're missing basically 3 to 4 million workers relative to that pre-COVID trend that we were on in terms of the size of the total labor force. Our data, our analysis suggests it's actually closer to 6 to 7 million people. There's effectively 6 to 7 million missing workers relative to the prior trend in this current, where we are today in this current business cycle. And that's obviously flattered a lot of wage statistics, irrespective of the mess that was the average hourly earnings last Friday. You had a significant decline in average work weekly hours, had a lot of part-time employees that dragged the number down, which is why I like looking at more stable measures of income and employment. Like, again, nominal employee compensation. We get that at the end of the month in the PCE report. And then every quarter, we get the employment cost index data, which again is corroborating that well above trend pace of nominal employee compensation growth rate that we observed in the most recent months. So in our opinion, it's going to be, this is a very boring Stereotypical business cycle. Everyone, like if you part of the problem with the pandemic is, and one of the things that's been great for me and our firm is we all spend way too damn much time on Twitter, chasing around charts and passing charts and looking at charts. And the reality is the economy doesn't move as fast as our retweet function. There's a series of processes that need to take place in the economy, namely corporate profitability needs to erode, and to a significant enough degree that corporates actually start to shed headcount, and that decline in total income is likely to be what causes the recession. But again, I think we're 2 to 3 quarters away from that at least.
Mm. And I often find, Darius, I'm curious if you agree that arguments that did not work over the past, let's say 9 months to make a predictive trend sometimes have better success going forward. And I'll share the example I'm thinking of, which is, let's say in May, this chart started to go around on Twitter that people's income had gone up only 5%, but costs had gone up 9%. So the consumer is basically down negative 4% in terms of their actual income. And if you'd use that to predict a recession, you would have been wrong, because bond prices, stocks outperformed bonds, all assets did poorly, the Fed hiked. However, I don't know.
And the economy wasn't in recession.
Exactly. I'm starting to think that argument might have some legs going forward. And I think particularly if you think of like the bottom quartile of income, the bottom decile of income, like a lot of that income goes towards non-discretionary things like gasoline, electricity, the stuff that is the most volatile, and over the past 3 months has gone down, but was really spiking higher. So I'm curious your thoughts on that.
My general thoughts is that this, as awkward and weird as this cycle has been from in terms of reopening and then the carting in the goods and carting out of goods, and how that's, kind of really had some, pretty significant influences both to the upside and downside in activity and in prices. I think we're now starting to get to the point in the business cycle, and I'll cite a couple statistics for you. If you look at the ISM services and manufacturing statistics, there's a lot of obviously subcategories or sub indices within that. Within both of those, you have the supplier delivery times surveys, percentage of respondents that are reporting slower supplier delivery times. Those things spiked in the pandemic, went way up, and now both of them are at or below their structural means, their long-term means. And so it's telling you that we're now back, and at least that's an indication, whether you look at port data, et cetera, China reopening, we're now back at a kind of a normal, I use that with significant air quotes, business cycle type dynamic. And ultimately, we're just kind of on that pre-recessionary path of the long and variable lags of monetary policy, one by one catching up with, borrowers in the corporate sector, borrowers in the household sector that are ultimately getting kind of restrained from incremental consumption and investment. Now, that process takes a while. It's going to take a while. And ultimately, again, I think, as long as that process, takes a while, you're going to have what looks, at least underneath the surface from a wage and income standpoint, an economy that can handle more rate hikes from the perspective of the Fed, which is going to deliver those more rate hikes. And ultimately, when we get to the point of the process where it can no longer handle any more rate hikes, i.e. we're, getting very close or in recession, that in our opinion, because the Fed is already projecting that, it's going to be a problem. Markets are going to have to scream, kick, yell like kids at a toy store throwing a tantrum to get the QE. This is not a Fed that's going to go, oh my God, the unemployment rate's at 4.6%. I got to throw QE on the market. No, it's going to say, well, we forecasted that. It's going to say we forecasted that. What's the big deal? And so that, in my opinion, we're going to have a Wile E. Coyote moment at some point in the second half of this year. I believe we'll start right around mid-year, because there's a couple of things we haven't talked about yet, which is net liquidity. We have the debt ceiling this year. We haven't had a real good one since 2011. You remember that one? That was fun. And it's the same setup. Democratic president did probably way too much from a fiscal policy standpoint. Aggressive, Republican Party who comes in and says way too much. We need to stop. And it's the same setup. Exactly what happened with Obamacare and the Republican Party, and led by the Tea Party, or not even led by the Tea Party, taken hostage by the Tea Party back then. And now, I don't know what they're calling themselves now, but whatever this small faction that's taking the Republican Party hostage at this current juncture, they're going to demand large concessions, and big changes to entitlement spending, et cetera, that the Democrats, based on their previous history of hiking the debt ceiling 3 times during the Trump administration without any concessions, there's going to be a big battle there. Mm-hmm. And that big battle, in my opinion, could create some market volatility as well in the middle of the year. So it's all kind of setting up for at the bare minimum, flat to up, positive, slightly positive first half. certainly, and it's very positive relative to a consensus that is calling for a really negative first half, including an earnings recession, to, no, the pain, in our opinion, from a risk asset standpoint, is certainly likely to be concentrated in the second half, if only because the economic pain broadly, not just in the U.S., is going to be concentrated in the second half, and there won't be any central banks, running at, first beck and call to deal with that from a policy standpoint.
Right. Yeah. So liquidity is super important for an investor. It's basically the ease with which you can enter and exit a position, very correlated with asset prices. And in this case, liquidity basically means money. It can be from the government, from the central bank, from commercial banks, from savings. But yeah, I mean, you have a chart of net liquidity, and we can put it up. Maps quite closely with risk assets. It had been going down, as people can see. Do you expect it to continue to go down? And I know there's a particular force that has kind of changed your calculus that's new.
Yeah, absolutely. So, we came into the year with the expectation that, this trend of lower highs and lower lows in net liquidity would likely continue. Citing our net liquidity model, where we take the Fed balance sheet, total assets, subtract both the Treasury General Account balance and the reverse repo facility balance from that as a more approximate measure of the amount of liquidity the government, the U.S. dollar liquidity that the government is either supplying or taking from the market. And based on our read through of what we're seeing out of Janet Yellen from the Treasury Department, it's likely that may not be the case, at least in the first quarter of this year, and potentially well into the first half of this year, which ultimately puts a floor into markets as well for the time being. So I'll start with kind of the first step in terms of her cash management techniques ahead of this debt ceiling fight, which, by the way, she's $64 billion away from, on a 30-something trillion dollar pile of debt subject to that debt limit. So we're pretty close. Now, pretty close, from that perspective means that she's got a bunch of tools and levers, who to pay, what to pay, draining down the Treasury General Account balance, which we believe will continue throughout the first part of this year. That's something that's going to be positive from a net liquidity standpoint, because again, that draining of that Treasury General Account balance is effectively supplying liquidity to the real economy. Or it's taking what was, liquidity that it was removed from the real economy and giving it back to the real economy. What's likely to also flatter net liquidity, at least in the first quarter and potentially through the first half of this year, is the fact that Yellen is actually targeting more T-bill issuance as a cash management technique. If you look at the last the last few auctions of T-bills, we've seen net debt increase by $18 billion. Relative to the previous run rate of T-bill issuance. So she's accelerating T-bill issuance as a cash management technique as well. And so that accelerating the T-bill issuance is actually putting more supply of Treasury bills on the market. And it's actually compressing what had been a very deeply negative spread between T-bill yields and similar maturity money market rates. Now, why does that matter? Well,
so are T-bill rates lower or higher than money market rates?
T-bill rates had been persistently negative relative to money market rates.
Yeah. The spread was negative. They were lower than the money market.
Persistently negative. And because there was a shortage of T-bills, and that shortage of T-bills, in my opinion, was part of the reason we saw asymptotic rise and exponential rise in the reverse repo facility balance, because those money market funds couldn't find assets to invest in, and so the Fed hiking interest rates, the reverse repo facility became a very attractive investment vehicle for those types of funds. Well, now if Yellen is flooding the market with T-bills as a cash management technique throughout this first part of the year, first quarter, maybe even the first half of the year, that's ultimately going to compress that spread and allow those funds from capitalizing, the Fed balance sheet basically, to capitalizing shadow banks, et cetera, in the money markets, which ultimately allows shadow banks like hedge funds, credit funds, pension funds, et cetera, not pension funds, but other types of shadow banks, mortgage lenders, et cetera. Mm-hmm. They now have the ample capacity to take on incremental leverage if they choose to, and ultimately can inflate asset markets. And so, those are two dynamics from a debt ceiling standpoint that are positive today vis-a-vis Janet Yellen's decisions in terms of how she's managing the cash ahead of that catalyst, but ultimately are going to prove to be doubly negative issues in the future, not the least of which is because we're going to have a political battle, very likely to have a political battle about the debt ceiling, which could result in a downgrade or something like that, or fears of a downgrade, if you will. But more importantly, when we get to the other side of this whole process, Treasury General Accounts going back up, could potentially see reverse repo facility spike again into the second half of this year. So it's very likely that, what could be a sideways to uptrend in net liquidity, and from the perspective of our model, to something that gives way to a much more negative trend in the back half of the year. So it all sets up for I wouldn't say like a good first half and a terrible second half, because I think we're already kind of fully priced from a good first half perspective. Maybe not fully priced. Could you get to 4,200 on the S&P? Sure. I mean, I've been surprised by markets, for the last 14 years. So yeah, it's not going to change. But I think when you're getting above 4,100, 4,200 in the S&P, you're starting to get back to valuation levels that no buy sider I talk to, and I talk to all the biggest firms and who's of the world, can support from a bottom up standpoint. You're going to be seeing stock prices and credit spreads that are just nonsensical in terms of where we are in the business cycle. And so I think
especially when interest rates are at 5.5%.
Well, that's the interest rates at 5%. That's the money man. That's the financial advisor type crowd and the retail investor crowd.
Right.
You've seen our research where we say, we went from dating our hot, sexy girlfriend Tina, the girl next door. Now we're back to the, our old, homely, kind of, the ride or die, hold you down type girl, Tara. We used to date Tara in middle school, right? Where, you had a significant spread in terms of, kind of short-term investment grade debt instruments relative to the yields you could get on, let's say, a dividend yield on the S&P or other type of riskier assets. And so at the end of the day, that spread will continue to rise, particularly as, asset market valuations come in, equity risk premiums compress, et cetera. And so ultimately you have, for a variety of reasons, not the least of which is Fed doing more than expected and valuations getting, just kind of into levels that are really inconsistent with where we are in the business cycle. You're going to have institutional investors that are unwilling to chase the market beyond a certain point. But I would also argue in the first half of the year, because of that flattering of net liquidity that we're going to see, particularly through the lens of what Janet Yellen is doing, and that likelihood that there are RRP and TGA, combined to offset quantitative tightening, potentially, overwhelm quantitative tightening. You're going to have a floor under asset markets as well, that is also supported by China reopening stimulus. So, I mean, these are some violent cross currents, Jack.
Yeah,
I've been doing this for a really long time. I think if you didn't do all the research and you did not understand the full range of probable outcomes, you really just wanted to anchor on one side of the distribution or the other, you could get really bullish or really bearish here. And I think it's very easy on a day like today where the market gets, Bitcoin's ripping, markets ripping on the CPI, to get really bullish and not understanding that full range of probable distribution associated with the modal outcome of the left tail. And I think just as easily as we are here today, we could come back in a few weeks and if Jay Powell has a super hawkish press conference on the 1st and markets are down at 3,800 and it's like, no. Everything we thought in December was correct.
I think you will. I think you will because it's going to be 25 basis points. I mean, it could be 50, but it's
25. They don't surprise the market.
Yeah, it's be 25. 98%. And then of course Powell doesn't want it to be a dovish meeting, so he's going to go hard on the reporters.
Totally. And so now then you're at 3,800 in mid-February, and then everyone's super bearish again, and people are going to get their faces chopped up. They're going to get their arms, legs, everything chopped up in the first half of this year. But ultimately, I do believe it's appropriate as an investor to trade this period of time, this transitory Goldilocks period of time with the bullish bias, because at the bare minimum, if you're in a range, you in theory should have lower realized volatility. You might start to suck in some more CTA, kind of systematic investors at the margins. And just generally speaking, everyone is positioned bearish. If you can, we can obviously observe that in the CFTC data across risk assets and across risk parity type instruments. And so it probably means you want to trade markets with a bullish bias, but we're probably already close to the upper end of that choppy trading range. Mm-hmm. So I wouldn't be chasing it here, with any gung-ho fervor. But ultimately, I do believe that range that you could trade with a bullish bias is probably going to either get punched in the mouth on March 22nd by that SEP and that dot plot, or at the bare minimum, definitely double punched and kicked on June 14th by the SEP, the dot plot. By the way, the debt ceiling is going to be an issue. All these things are going to be coalescing at the same time. Growth is starting to inflect lower across the U.S. and global economy.
Yeah. So what does that mean for asset allocation? Like if someone had been, overweight cash, like short stocks, short the high beta stuff, is it time to call it in and go long?
Well, so it'll depend on where we are in that range. I'm using the S&P as a catch-all proxy that we all understand. At 4,100 on the S&P, it's time to go short.
Yeah.
But at 3,800 on the S&P, it's probably time to go long, as long as we're in this kind of, this regime where we're debating where the distribution is very flat. It's basically what I've been trying to say for the past 45 minutes, is that the distribution is very flat. The right tail risk is probably just as probable as the left tail risk, or maybe slightly more probable than the left tail risk, but it's probably just as probable as the modal outcome. But once that distribution starts to change in terms of the shape of distribution, by the middle of the year, that right tail risk probability is going to be declining and the left tail risk probability is going to be rising. And that, in my opinion, is going to be a big issue. So how you posture yourself as an investor with respect to beta depends on where we are in the markets. Right now, I would argue, it's near fully priced. Could you have another 100 points of S&P? Sure, why not? Again, like I said, I've been surprised many 1,000 times in this game we play. But from a style fact, from a alpha standpoint, I think the cyclical leadership that we've observing, and this stuff, I talk to with our buy side clients all the time. Our model started calling out a rotation in the cyclicals, I want to say at the beginning of last week. And that's obviously been very much augmented by these developments from a Goldilocks signaling standpoint, US CPI, NFIB data we got a couple of days ago, China stimulus. And I think that is durable in terms of the first half of the year, because again, right now the markets are comfortable pricing in better than expected growth globally. And there's no reason for them to be concerned about that until, again, we get into the back half of the year where that liquidity cycle inflects and ultimately that growth cycle inflects.
So when it comes to so beta is its own story, as you say, but when it comes to within the stock market in terms of sectors, it sounds like you're saying it's 2021 again. Get as much copper miners as you can get your hands on.
I don't know about copper because I don't know anything specifically about copper, but I do believe that copper is probably going to work. I mean, base metals are breaking out.
It's going up. Copper's going up.
Yeah, no, but yeah. So like, we run a variety of quantitative signaling tools at 42 Macro, and on our volatility adjusted momentum signal, base metals broke out a few weeks ago. And it's one of those things that didn't make a ton of sense then, but once you start seeing China stimulus headlines, you're like, oh no, wait, somebody knew something, or at the bare minimum was willing to bet on that's something developing. And so I do believe, again, it's dollar down, which I can't believe we did an hour-long interview, haven't talked about the US dollar, which is the dominant feature in any macro model you can. The dollar, the way I think about the US dollar, it is the residual of the supply and demand of global credit. Jeff Schneider obviously has been the kind of a thought leader, kind of in terms of the Eurodollar system, which in our opinion is the dominant system of how, credit is, created and destroyed across borders. The dollar's breaking down, which by the way, it's breaking a very significant Fibonacci retracement level here, right? If you go back to the January 2021 low in the dollar to the, I want to say September, October high in the dollar, we are breaking past that 50% Fib retracement level. And bull markets or bear markets don't correct beyond the 50% retracement level. And so in my opinion, that might be a pretty significant signal that, this global dollar credit machine is actually getting activated here, could potentially be transitory. Now, why is that the case? Well, the world's second largest economy is reopening and stimulating. If you go back and look at the past, 15 years of Chinese monetary and fiscal policy, in 10 of those 15 years, monetary and fiscal policy in terms of the impulses both peaked in Q1. And so, China, they tend to like to jam, come out the gate swinging, come out of the round swinging, and, they want to jam it in here. And so I think we're going to see a ton of monetary stimulus in Q1 out of China, a ton of fiscal stimulus in Q1 out of China. And I think that's what's supporting things like copper, this recovery in cyclicals in sectors and style factors in cyclical sectors and fixed income relative to the defensive counterparts. That to me is an easier call to make than, kind of, should I just be long or short beta? Because again, to me, that depends on where you are in that choppy violent range,
Right. What about the tech stocks, and particularly like the high value, high growth, profitless tech stocks? Obviously, the worst year possible for 2022 was for them, but is there any silver lining in the short term in 2023?
Yeah, no, I mean, if you can buy a copper miner or a piece of copper, you can buy a high value tech stock. But again, that to me, that's not that as an investor, that doesn't make sense, in terms of with the broader asset allocate, with the broader sort of distribution of outcomes. Will it work? Yeah, these things are all correlated, right? S&P goes up, all that stuff goes up. S&P goes down, all that stuff goes down. So they're not going to decouple. But from the perspective of what I think has the most risk reward to the upside, and let's call it the first quarter to maybe even the first half of this year, I think it's the cyclical sectors and style factors. Because again, we have a weak dollar. What does weak dollar do? It inflates emerging markets relative to developed markets. It inflates cyclicals relative to defensives. It inflates commodities, physical assets relative to digital assets. Why would you fight weak dollar when you can just go it's easier to make money in weak dollar in those types of trades as opposed to, the stuff that Kathy Wood's been buying the dip in the whole way down.
All right. Dangerous question, Darius. So the dollar is getting weaker. and we're in Goldilocks or transparent,
Transitory Goldilocks.
transitory Goldilocks.
The technical
Those two
term
environments
is the
sounds like a good
probability
environment
of
for Bitcoin.
Goldilocks has risen to a market significant degree that market participants
Yes.
need to price it in.
We're trading like Goldilocks. Okay. So dollars weak, trading like Goldilocks. Well, how about Bitcoin?
Bitcoin is doing exactly what you would expect to do. I mean, the annualized return, by the way, we back tested all this stuff. The annualized return of Bitcoin in Goldilocks is 400%. 400% on an annualized basis. This is data going back to the history of the entire Bitcoin time series. When the U.S. economy or the global economy are in the Goldilocks, in the GRID, Goldilocks is Goldilocks, the annualized expected return is 400%. Bitcoin is finally waking up and realizing that this probability of Goldilocks is A, rising, but B, much higher than it was, from a probability standpoint a few months ago. Now, again, when we get to 4,100 on the S&P, or maybe slightly above that, I don't think Bitcoin has a hope in hell of getting much beyond wherever it will be at that time, going, where it will be at that time when it gets there. But again, I think you just have to trade risk from that perspective of that violent, choppy range that I think we're going to be stuck in for a while.
But this is a short-term thing for Bitcoin.
Yeah, no, yeah. Well, everyone's duration is different, right? But again, what I'm trying to outline is I think we can be in similar type of market dynamics that we've experienced year to date between, at least through into the March FOMC. And if the March FOMC is not the catalyst, then I don't really see another catalyst to get us to inflect out of this particular market, this market narrative, this market activity in terms of market leadership, et cetera, until we get to the June FOMC. I think by the time we get to the June FOMC, not only will it become increasingly clear to market participants that the Fed has already done more than is currently priced in today, but they're less likely to pivot when the going gets tough. So they're going to hike more by the June FOMC than what's currently priced in today, which is a problem relative to the business cycle. But they're also via their summary of economic projections going back to those core PC unemployment rate forecasts that we highlighted earlier, and maybe even their GDP forecasts as well. They could take that from 0.5% to zero or even negative by the June FOMC. I think that combination of all those different dynamics on top of, the debt ceiling issues that we could have politically, the inflection in the liquidity cycle on the other side of passing the debt ceiling, and oh, by the way, the inflection in growth, both from an expectations and realized perspective, once the China impulse runs out, and we're left with, kind of everyone's left swimming naked. I think by the middle of this year, the market's going to really start to look at, the second half of this year and say there's a lot of bad stuff happening and there's not a lot of good from the perspective of liquidity provision.
Mm-hmm. That makes sense. What about China itself? Those Chinese stocks have been on an absolute tear past few months.
Yeah, no, they got a ton of upside from here. They're not as cheap as you would think they are. I did a bunch of valuation work earlier today on Chinese stocks relative to their global counterparts, but they're still relatively cheap, versus versus things like U.S. equities, Japanese equities. So it's not Chinese equities definitely have upside. In fact, I don't see a legitimate reason why Chinese stocks have to inflect negatively in that second half process that we see coming down the pike. I think they could probably China stocks are going to do this while everything else is doing this. But I do believe Chinese stocks can probably continue to grind higher in that environment because, again, from an institutional capital allocator standpoint, everyone pretty much got sucked out of China. You basically had the U.S. and China threatening to splinter apart from a regulatory standpoint, which ultimately made it uninvestable for a lot of investors. And I think the fact that Xi seems to be kowtowing to the West in terms of some of this regulatory policy initiatives that they're changing, three red lines in the real estate sector is getting pulled back a little bit. I think at the margins, you could see persistent institutional flows into the Chinese equities because, again, people just haven't been there for a while. And it's going to be one of the real legitimate bull stories of 2023, particularly when you get into the back half of 2023, where it's not like, right now, everyone's kind of benefiting from a higher than expected probability Goldilocks, which, by the way, our model is always called the whole entire time. We always thought, this period of the spring between December and the spring was going to be a reasonable chance of achieving Goldilocks economically, but that's going to dissipate. It's going to dissipate in the US, it's going to dissipate in Europe, going to dissipate across broad swaths of the global economy. And China is going to increasingly be left alone in terms of, maybe even having ability to continue accelerating. I'm not so sure, but, I don't have to answer that today.
Yeah. No.
A lot of data to analyze between now and then.
So you think the VIX stays pretty, 20, 25-ish in this next short-term Goldilocks thing?
No. I think the VIX could easily break into the teens, maybe trade between, I don't know, 18
Yeah,
and
lower.
20.
What I
Yeah.
meant was not 30s and 40s.
No. This is not where we are. Transitory Goldilocks is not consistent with VIX above 20. Goldilocks is not consistent with VIX above 20. But again, I keep saying, I want to make sure everyone hears transitory Goldilocks. We are not in Goldilocks. It's just that the probability of Goldilocks is accelerating in the US and global economies, at least according to our models. And that was the least position for outcome if you look at investor positioning. And so markets had to move aggressively in recent weeks to try to price that in. And they may continue to move aggressively to price that in. I just think it has a cap to it. We're not rallying to 4,500 or back to 4,800 on the S&P because, again, we still have this liquidity cycle overhang. We still have the business cycle overhang in terms of likely heading into recession in the back end of this year. Again, our expectation is Q4, so the commencement of that could be as late as Q1 of next year.
Yes. The market is not necessarily the economy, not necessarily in Goldilocks. The market is trading as if it is in Goldilocks, and your models are saying it's possible that they will continue to trade in the Goldilocks for the short term, and people should be aware of that.
Yeah, for 1 to 2 quarters at most.
Yeah, there we go. Well, Darius, thank you so much. It's been a pleasure as always, and thank you everyone for watching.
Appreciate you, Jack, man. Always a pleasure. And come check us out, 42macro.com, if you want to see all the analysis in our portfolio construction process, which takes all this analysis and helps investors make and save money with actual ideas, risk managed ideas.
There we go. Thanks, and have a good one.
Appreciate you.